Now we go to the next speaker, Michael Markhoff. He is going to speak on estate, gift taxes, and trust options for children. Attorney Markhoff is a partner with Danziger and Markhoff LLP. He's a graduate of Columbia College and Brooklyn Law School, and is listed in Best Lawyers in America Trust and Estates and category, and super lawyers, and as a trust and estate category. Michael was named Trust and Estate Lawyer of the Year for White Plains, New York in 2016 and 2018, and Best Lawyers in America. Michael, go ahead.
Thanks, Thomas. So thanks very much, everyone. I'm going to talk about estate planning and some, as Cecil was mentioning, Biden proposal type things for half the session. And then my partners, Andy Roth and Mark Hamilton are going to talk about CARES Act and other issues. So just quickly with estate planning, right now, you probably know we're in an era where we have unprecedentedly high estate tax exemptions, 11,580,000 for each spouse. And it's something that's called a portable exemption. It means without doing anything, it doubles so we can shelter 23 odd million from estate tax. When you go over that, there's a 40% tax. So that's covering 90 odd percent of the country. What is proposed, and I agree with Cecil, I read proposals and I try not to remember them because they don't always occur and don't always get enacted. But the scuttlebutt has always been that Biden will lower the exemption to 5 million each. So knowing that for this year, this has been a very, very busy year in the estate planning world because our clients are all sort of worried with the federal exemption going down. What are they going to do? And the planning has usually been around the states because those exemptions are lower. Connecticut is a 5 million one exemption, and it's set to go to 7.1 next year. New York is 5,850,000, and New York goes up by inflation every year. So maybe roughly 6 million next year. And the difference between the two, federal and state, is the state, taxes, the rates are a lot lower, but it's hundreds of thousands of dollars for people, if not $1 million or more of tax. So mostly the planning has been around the state, but this whole thing with Biden, being concerned if he won, he'll lower the exemption, has created a tremendous amount of work. So what's resulted is that the only way to really lock in the high exemption is to make gifts, and we have to do this before the end of the year. And what's really been going on this year with us and our clients is they've been gifting to something called SLATs. Everything in the tax law has an acronym, and this stands for Spousal Lifetime Access Trust. What it means is it's sort of like having your cake and eating it too. It's a way of a married couple making a gift where one spouse makes a gift so the second spouse benefits, and the second spouse makes a gift so the first spouse benefits. So in a funny way, even though clients are making gifts, they're still living on the money. And that's what's sort of great about it. What's interesting is we've had these trusts around for 100 years. We've been using them for other purposes. And all of a sudden, I think a lot of us woke up and realized, such a simple plan really applies for gifting. And the idea is that you would make gifts now to use up some of that 11 odd million exemption. And technically, you really would, if you were lucky enough to have this problem, you would make gifts that would exceed 5 million in 2020. And the reason is because the IRS has already said and ruled that if the exemption does go down in 2021, that you are grandfathered in. So if you were lucky enough and you made a gift of 7 million this year and the exemption goes down to 5 million in 2020, you're grandfathered in. You got an extra $2 million out of the estate. So it's something that if you're in that position, you've only got a few weeks to go, but it's something to seriously consider. And we've been having numbers of clients, scores of clients do this during the year. And even today and yesterday, I was getting calls from clients who finally are thinking now's the time to do this. They were doing it during the year after Election Day. They were sort of in a slow mode, but now that they think Georgia's going to flip the way things are looking, something could change with the tax law. I agree with Cecil. In the end, I think I don't think much might happen in the end in 2021, even if Georgia flips, because I think the president will be preoccupied with COVID and a bunch of other things, and the tax law is not really on the top of the list. So it's possible it may not happen. If it does, it will very likely be retroactive to January 1. So it makes this planning even harder because in essence, it kind of brings us back to this year and trying to cram in a lot of gifts and a lot of planning now. So these slats are excellent for this kind of gift, again, because you're giving away money, but your other spouse, in essence, is living on it. What you have to keep in mind is that what's really happening is the appreciation is what you're getting removed from the estate. Because very simply, if you have $20 million and you give away 10, the sneaky thing the IRS does is they add back those gifts when you die, so that you're really being estate taxed on 20. So everyone asks, well, why'd you have me gift? It's because the growth on that 10 is what you're getting out of the estate. So you really want to give away growth assets. The downside is, like a lot of estate planning, is divorce. These are irrevocable trusts. And once you do them, they're done. And if a married couple gets divorced, you can't unwind it. So it's something that's set in stone. You have to sort of take that into account. And the other is death. If husband creates a trust for wife and wife for husband, if husband dies first, wife is still living on the husband's trust, but that trust that the wife created for the husband now goes down to the children. She can't benefit from it because you're not allowed to benefit from a trust that you create for yourself. Otherwise, it's back in your estate. So it's something to keep in mind when gifting. And then the last thing with gifting is when we're doing these trusts, they will say trust for spouse and then trust for children. And I've done this before in other sessions. What's very important to keep in mind is you very likely want to draft these trusts so that they're what we call generation skipping trusts. What that means is that it's a trust that goes for the lifetime of the children. And when children die, what's left over goes to grandchildren. We do this to be very quick about it and blunt. This keeps the money away from the sons-in-law, daughters-in-law of the world, which is pretty much what I hear from clients within the first 7 minutes of meeting them, is that they worked hard for this money and they don't want it by accident, by death or divorce of a child, ending up with a son-in-law, daughter-in-law. So we want to do it where it stays in the family. And then lastly, with what do you do if you're lucky enough to be above these exemptions, besides gifting, is life insurance is a very common planning, and charitable planning. If you buy a certain kind of policy called a second to die policy or survivorship policy that's on both spouses, that's very often used to help pay the estate tax. Or charitable planning. The more you leave to charity, just like Cecil talked about with income taxes, it works for estate taxes. A simple zero estate tax plan is leave whatever we're allowed to leave under the states and federal exemptions to your family and leave the rest to charity, and you'll have a zero estate tax. So with that, I know that's very quick. I'm going to stop and turn it over to Andy and Mark to talk about the CARES Act.
This is the season to be jolly, and I think you'll all be jollier if you have a qualified retirement plan in place, because you're going to wind up saving a lot on taxes. Before we even get into the nuts and bolts of the program, the state-of-the-art plan design for, say, one person, sole proprietor, for example, would be a traditional defined benefit plan, and then you also have a profit-sharing 401k plan on top of that. And the deductions can be huge. It could be $200,000, $300,000, $400,000 potentially. The state-of-the-art plan design, if you have a bunch of people floating around, it could even be 2 or 3 or more, would be something called the new comparability profit-sharing 401k plan, and then a cash balance plan on top of that, which is a hybrid defined benefit plan. And then the owners can get the same $200,000, $300,000, $400,000 potentially. Now, also keep in mind that a qualified plan is really the most spectacular tax savings vehicle you can have, because under the old law, which goes back to 2017 and before, And then the new law, 2018 and thereafter, a qualified plan is still a sacrosanct deduction. So in the old days, which is not so long ago, people weren't even aware of it, but they were typically an AMT, the alternative minimum tax. And it turns out you're in a flat tax, and the only deductions you really were able to maintain were charitable contributions. And I know Cecil, who's a very tough act to follow, by the way, is very charitable. And then also mortgage interest, but you lost all your other deductions. And now, as Cecil points out, you got your SALT deduction, which is capped at $10,000. So basically your deductions are capped anyway. And a lot of our clients now find themselves in the standard deduction category. But with a qualified plan, you can really blow out these numbers and really save a tremendous amount in taxes. And then the only other thing I wanted to point out with respect to, since I really wanted to go into new developments in the field, for those of you or those of your clients that have profit sharing 401k plans, those plans are going to have to be amended and restated again for something called Cycle 3. Previously it was PPA, the Pension Protection Act, ECTERA, GUST. So now it's Cycle 3. The window opened August 1st of this year, and it closes on July 31st of 2022. So please make sure if you have these types of plans or your clients do, please make sure they're updated in a timely fashion. Okay, on with the program. So very, very quickly, Danziger Markhoff is a boutique. We're based out of White Plains. We also have an office on the island. And we do three things: employee benefits, specifically qualified retirement plan design and implementation and administration. We're an anomaly. We're a third-party administrator. We currently administer about 1,800 plans. We have 4 risk attorneys, including myself and Mark, 7 enrolled actuaries, and about 20 plan administrators. We also have a trust and estates practice that Michael Markhoff heads up, as well as a corporate practice. Next slide, please. Okay, we could skip this slide. We know the CARES Act was enacted back in March. So there are a couple of points about the CARES Act that I wanted to mention to you, once again, focusing on new developments. So obviously, a lot of people had problems this year, as Cecil pointed out. But if you are a qualified individual, which is basically someone who is diagnosed with the coronavirus, unfortunately, or has suffered adverse financial consequences, which are a lot of us, you potentially qualify as a qualified individual. You just have to self-certify. That's no big deal. And then you can get the benefit if your plan sponsor has opted in to this feature in their plan to be able to take out a coronavirus-related distribution. Next slide, please. So with respect to a coronavirus-related distribution, you could take out as much as $100,000 out of your plan, and it needs to be done by the end of the year, by December 31st. Next slide, please. One of the benefits is that you circumvent, if you're under 59 and a half, the 10% excise tax on early distribution. So you don't have to worry about that. And then the tax treatment can be done in one of 3 ways. You can take that 100,000 out and pay all the tax now and keep the money, which is, certainly perfectly fine. Or what Cecil would recommend is you take it out and you can straddle 3 years. You can pay the tax ratably over 3 years. So $33,333 in 20, then again in 21 and 22. And then you don't have to pay it back, or you can pay it back within 3 years of taking it out. And today is December 4th. So if you pay it back by December 4th of 2023, I know it's a long ways off, then you can go back and amend your returns in 20, 21, and 22 and recoup at a bare minimum the federal taxes that you paid during those years. Now, I know a lot of you, live or are residents of Connecticut, so you guys don't have to worry. You can also, get refunds on your state taxes. However, if you look at the caveat at the bottom of this page, New York decoupled from the CARES Act, which means that if you're a New York resident, New York State, New York City, and you take this money out, you're going to get slammed with tax on the 100,000 in 2020. So please, keep that in mind if you plan on taking that money out within, by the end of the year, within the next month. Next slide, please. Okay, the other CARES Act point that I wanted to make was that RMDs, required minimum distributions for defined contribution plans, which are your profit sharing 401ks and IRAs, are waived for the year. So if you waited to take your first distribution that you were required to take for 19 and you waited to do it in the first quarter of 20, you had to do it by April 1st, that was waived. And also any, obviously, RMD that you need to take in 2020 was waived as well. And this does not apply to just qualified individuals. This applies to everyone, but it does not apply to defined benefit plans, including cash balance plans. Next slide, please. Okay, now let's turn our attention to the Secure Act. Thank you. You read my mind, Mark. Thank you very much. So the required minimum distributions, after speaking about that, the age is now changed to 72 from 70 and a half, making it very, very simple. If you were born on or after July 1st of 49, your minimum required distributions are required to be made at age 72. If you were born before that date, the age 70 and a half applies to you. Next slide, please. Okay, one of the negative things was the elimination of the stretch out for beneficiaries. So if you're an IRA beneficiary, defined contribution plan beneficiary, other than a spousal beneficiary, the limit on the stretch is 10 years. So spousal beneficiaries still get the stretch, but if you're a non-spousal beneficiary, generally you're not going to get the stretch, and I'll show you how that works in a second. Next slide, please. Okay, so if you look at this slide, I'm not going to go through all the numbers, but I just want to illustrate the magnitude of this change. So, the husband in this case has, say, Roth 401k money. He puts it in every year for about 20 years. The money grows. He winds up moving to sunny Boca Raton. It continues to grow. Then the husband participant passes away. It goes to a spouse, and it grows. And no one, once the money goes into a rollover IRA, a Roth IRA, that is, you don't have to even take MRDs or anything. It's only when it hits the kids level that you have to start taking out. So in this case now, it used to be that we had the life expectancy of the child or the grandchild to take it out. So now we have to limit it to 10 years, but you can wait until the end of the 10th year to take out that full lump. And then the amount would be, next slide, please, roughly $6 million. And that would come out income tax free if you have a Roth. Now, just to show you the magnitude of this change, we used to have slides which showed the son being the first beneficiary. Life expectancy in that case, when he was 60, would be 24, 25 years. Instead of 6 million, it was 8 million. And then we used, Michael's generation skipping stuff. We bypassed the son, gave it to the grandson, who was 20 at the time, 63-year life expectancy. Guess what? The $6 million was $36 million because it could come out over a 63-year period. Now we're limited not to 24 years, not to 63 years, but to 10 years. So keep that in mind. Next slide, please. Okay, this is very, very important. Very important. Big change in the law. So it used to be that you had to implement these plans by the end of the year, meaning they had to be signed by the end of the year. And I don't have people calling me or people calling Mark on January 1st, January 2nd. I want my plan for the prior year. It's too late. That ship has sailed. Now, however, you have until the tax filing deadline, including extensions, to implement the plans for yourself and your clients. We still don't think it's necessarily a good idea to do that because a lot of our clients like 401ks, and in order to have a 401k, obviously it's funded out of payroll, and payroll is exhausted at the end of the year, meaning December 31st. But now the rule is really the same as a SEP. You could with a SEP, that was the one Band-Aid we had. So if someone called and said, I want a plan, and they were doing it after the year and they wanted it for the prior year, we'd say do a SEP for the prior year, and then we'll set up a qualified plan for the current year. Now we can actually set up a qualified plan for the current year after the end of the year. not a 401k, of course, but after the end of the year for a profit sharing piece or a defined benefit piece or a cash balance piece, as long as it's done within the tax filing deadline for the individual. So that's very, very big. So please be aware of that. Thank you, Mark. Once again, reading my mind. Okay, so for those of you who have safe harbor 401k plans, there are two types of safe harbors. One's the safe harbor match. Those rules haven't changed. However, the 3% non-elective safe harbor rules have changed. It used to be that you had to do annual notices 30 days before the beginning of the plan years. That now those are gone. You don't have to do any notices, and you can actually set up the safe harbor during the year. You were never able to do that before. You can now, on it for an existing 401k plan, if you're failing ADP testing, you could set it up during the year, which would be great. And you could actually do the 3% by December 1st. So we've sort of passed December 1st, we're now December 4th, but now you could still even doing it now, even into next year, if you change the 3% to 4%, and you can satisfy the ADP test. And that means all the highly compensated employees in your employ will be able to utilize their 401k to the fullest, 19.5 if you're under 50 this year, and 26 if you're 50 plus, and the same limits apply for next year. Next slide, please.
Andy, you might want to mention that the safe harbor match rules haven't changed.
Yes, I did.
Okay, good.
Thank you.
Yeah.
Thank you.
And can you wrap it up in another couple of minutes?
Yes,
Then we'll
I'll
have to
wrap it up in
question.
literally 2 minutes. If you give me 2 minutes, that's fine. So the retirement plan credit. So anyone who wants to set up a new plan, potentially you can get a credit for each of 3 years, meaning 20, 21, and 22, depending upon demographics. You can get $5,000 a year, potentially even $15,000. It used to be $500. And last slide, please, and then I'll put everyone out of their misery. Okay, so for those of you who do have 401k plans, you could always in the past eliminate part-time people. Those are people that render less than 1,000 hours of service. They don't have to be included. Now, beginning next year, you're going to have to start counting long-term part-time employees, meaning those people that render at least 500 hours, but less than 1,000. And then if they have 3 consecutive years where they do that, and there's a proposal out there to limit it to 2 years, but let's say it's 3 years, they have to be included in the plan in 2024, solely for 401k purposes. The employer doesn't have to give them a dime, but they do have to have the ability to participate in the 401k plan. With that, I thank you so much. I really appreciate it. And I know I went over a lot, but hopefully it was understandable.
Thank you. Thank you. Prasad, you have any questions?
Yes.
I think I did see some questions.
Yeah, I have a couple of questions. Some are my personal and some are from the chat group. So for Mark and Andrew, thank you very much. It was a good presentation. And the question to you is like, can you talk something about estate planning for a single person?
Yeah, I'll
That
say that.
would be Michael, yes.
Yeah, for the single person, basically you get the federal and state exemption. You can still do gifting. You just can't double it because the person's not married. But the gifting concept still is applicable if you are over the federal number. More specifically, if you're over what could be the new federal number of 5 million. You can make gifts to grandfather yourself in, but the difference would be you're making gifts to other people, whether it's children or other family members or friends. So you don't really get the benefit of being able to this sort of back end way live on the money because there's no spouse. So gifting is still there. All the techniques are still there. It's just that it's not as favorable when you're not married because once you give the money, it's gone.
Good. So if any single person, if they want to gift, please add my name. So my name is Prasad Chintalapudi, and you can give how much. There is no limit to gift, right, Mike?
There's the annual 15 gifts to you are unlimited in the world, but
Yeah, anything. I'll take anything. No worries.
Yeah,
So,
it's 15,000 a year or this 11,580,000.
Yeah, good. So, and Mike and Andrew, you spoke more about like these wills and trust. Recently, there was a news like the Japo CEO of $840 million guy who didn't have a will. So what is your thoughts on like, and why people don't have the wills and why the wills and the trust are for anyone, what are your recommendations on that?
Well, frankly, the reason they don't have wills is because, you know, inertia sets in, or people are lazy, or they're scared. I mean, you know, I have clients, I meet with them, I do a draft, and sometimes it takes them 2 years to come back to sign it because they think they're going to die. So I don't know, it's human nature. I'm sort of immune to it. But if you don't have a will, you know, you're stuck with whatever your state tells you how your assets will be disposed of, which is somewhat arbitrary. In New York, most states say if you have a spouse and children, half goes to spouse, half goes to children, and that's a horrible result. So, and if you have minors and you don't have a will, and both parents die, then you need to have a guardian. And if you don't name anyone, you're really begging a fight among your family members. So it's really critical to have a will. You focus on it for a couple hours, and you're with an attorney, and you're done. So it's worth doing.
So can you emphasize, you both, like, and once again reiterate how important is will and a trust?
Yeah. Well, like I said, it's tax planning, and then it's also property planning. That's if you don't take advantage of some of the state exemptions you get, it's very likely the family members' friends are going to pay a high estate tax. So half of estate planning is trying to minimize taxes, and the other half is making sure you have assets go where you want them to go. You know, again, if you had no will, assets are going to go by what the state says, and it's unlikely you want that result. So you're going to want to have a will that dictates where you want things to be, how you want them to be disposed of.
Good, thank you. And I got another question, and I really don't know what this means, but I will ask. Can I direct MRD to
Yeah.
charitable trust without paying taxes on
Yeah,
it?
what that's about is if you're over, well, it's 70 and a half, not 72 for this example. If you're over 70 and a half, you can direct up to $100,000 from an IRA. It's not a qualified plan, but an IRA directly to a charity, or it could be a charitable trust. And the virtue of that is if you normally took money out of an IRA, paid the income tax, and then gave the net to charity, you still have about a third tax on what you're doing. You're only getting a benefit of a portion of it. But with this special part of the tax law, you can direct about up to 100 grand. It goes straight to a charity, including a charitable trust, and it's not even shown as income. So it's basically 100 grand comes out of your IRA, goes right to charity, and you don't even have to recognize it as income. So it's a great tool.
Oh, that's good. That's good to know.
Yeah,
Thank you.
Prasad,